All right, we should be live. The Prospero.ai stock market live stream. We are in the second quarter officially, April 1st, 2024. We have a lot of good stories to talk about today. Hope everybody enjoyed their extended break from the markets. We had Friday off, and we are back as I wait for a few stream viewers to stroll along in here. Let me get some likes and comments in the chat. They are good for the algorithm. Let's see who's here today viewing the stream. Without further ado, I'll take you through some of the stories we're going to be talking about today, and then we'll get into the breakdown. But like I said before, Q1 is officially over. Hey Joseph, welcome back to the stream. Good to see you. Q1 was great for tech stocks. We're going to be getting into, if that will continue throughout Q2 and, if not, what the playbook should be instead. Then we're going to be spinning into AT&T stock, which had a massive data leak of over 7.6 million customers. And the gambit of things they leaked were, basically everything, if you had any information on there. But the stock didn't even react too much. So I'll spin that to George and kind of talk about what that means. Maybe we'll highlight some good cybersecurity companies and stocks as we think it's going to become more and more important going forward in the markets. Next, we have Microsoft unbundling Teams and Office products, getting ahead of antitrust concerns that they forecasted going forward if they had kept those things bundled. And they already did this in Europe, but now they're doing it globally. So those products will be separate for all users. And we're kind of in a lull of earnings season right now. There's not much going on. Hey there, Romel Camaro. Good to see you in the stream. Glad you're in here. But like I was saying, earnings season will start again soon. I believe April 15th, the big banks report. And with the rate cutting environment expected to begin later this year, we'll kind of take a look at the bank stocks. If you're a reader in our newsletter, you probably saw that the tech rally is becoming less and less. It's looking less and less like it will continue as vigorously as it did in Q1 probably. So we'll highlight the bank stocks, see if they're interesting. They trade very cheaply. So we'll take an in-depth look at them. I see Topher in the chat, bought T, CrowdStrike. What is S? And Zscaler today. What is S? What's the ticker S? Comment that, let me know. But yeah, good to see you in here, Topher. Glad you'll probably be paying attention to when we talk about the AT&T data leak. All right, two more topics that we're going to go through today. The Sam Bankman-Fried sentencing happened. He got 25 years in prison, and the judge that ruled on his sentencing gave a pretty crazy quote that I'll read later when we get to the story. So you have to stick around until then to hear that quote. But we'll kind of talk about that and what that situation means for crypto and Sam Bankman-Fried, the end of the saga for him. Let me actually mute George for a second. Okay, there we go. George is going to be joining us, by the way. He's the empty frame right now, but he'll be joining in a second for everybody that's in here. Last and not least, we have a story about the Fed, which in 2023 lost the most money they have ever on record, over $100 billion, and kind of shows the state of what's happening, government, financial world, just going deeper and deeper. Welcome, George. Good to see you back in frame.
Get closer to my part. You were doing great.
Yeah. So let's take a look at the market today and how it opened up. So it looks like the markets are down. They're actually mixed. QQQ is up. SPY, Dow, and actually IWM are all down, or the Russell. Let's take a look in Prospero. QQQ net option sentiment is at 47 right now, and the SPY is at 51. So we're seeing the SPY continue to be higher than the QQQ for the time being, although that gap is kind of smaller than I think we've seen recently. Um, do we want to kind of explain to the people, George, a little bit about how you're feeling about the market currently, how it's looking a little bit uncertain, and maybe tech isn't going to be able to continue driving uh, the market like it has done? Or, I'm saying tech, but it's really been AI that's driven the markets to all-time highs, especially, you know, what Prospero's the signals I've seen in NVIDIA and SMCI over Q1. And, since today is the first day of Q2, we'll kind of talk about maybe how people should think about the next 3 months of the market.
Yeah, so for people that stay till the end, we're definitely going to go through all the signals, including our new like market cap analysis, where we look at value and growth for small, mid, and large. Because one of the things that I saw that really got cemented even more, and I'll even just like pull it up, both in the newsletter and then kind of like a live look. Essentially what we're looking at here is I'm looking for is I was observing some softening in tech, but we actually, when we looked at instead of tech, when we looked at growth, we actually got an even better, clearer picture as to what was going on. Because as we talk about all the time, tech doesn't include like Tesla. Tech doesn't include Google and Meta. So a lot of the big AI push was not really getting covered. In what we were talking about there. So a big thing for me is kind of ensuring that that does get talked about. And so, what we're basically looking at there is that, and I'm going to pull this up right now, like what we were seeing yesterday was, and we normally do this with sectors, right? And we'll show you how, I'll basically show you the point that I was talking about. What we're seeing is a very clear, like softening in large cap growth. And what's so interesting, what we talked about it and why this had to be a part of the newsletter and a big part was that actually you can see over the last year, the only thing that really performed well was large cap growth, which is obviously AI driven. And you're pulling in like, a lot of, AI broadly, not just tech. You're talking about the comms thing plays, companies like Tesla that are growth companies. So this was really cool because we had never done this analysis. And it pretty much just showed the last month we were seeing a correction because pretty much everything that didn't do well in the last year has done well in the last month. So we rethought it. So I have like a slight tweak for you, Stephen, and we can kind of look at how it's playing out because, in talking about the lack of clarity, right? If you look at tech, yeah, there's a softening, but you didn't see like the exact same trend. Like there's other there's other basically consumer discretionary things, even communications doing well. So that kind of clouds the point that we're making of a very clear story around a growth softening, right? A large cap growth. But today, we actually have seen large cap growth charging back. And we'll kind of show you, I would expect, even looking at it from the close yesterday, we're going to pull out our new cap growth auto. And I'll just share this because we don't update this every day, but you can always go in and see basically the last time it was updated. And if you ever want to ask us to update it, we've turned on commenting, right? So anyone with the link can comment. You can just pretty much ask us to update it whenever you'd like. Popping this in here, but we're going to update it right now so people can kind of take a look at what we're seeing in terms of the change. So I think we want this to be 28. This to be, I want this to be 20, I think 20, 25. Trying to do the math on that, and I think that's the right math. And then this is still going to be the same because of the leap year. Oh, we're finally in the new year on this. On the 3 month, 6 month. And we're just updating this live so everyone can get a good handle on like how much kind of like, I think the trend Stephen was talking about is starting to reverse. And for those that don't know, we always update our model portfolio at the end of this. And we even do like in our investing letter update. Our model portfolio is our trading strategy. And wait, is that right? Are they all of these are up over the last year? 4/1/23, 4/1/24. Yeah, I guess on a different horizon. Oh, but they're just up in different ways. I see. So yes, as you can see, large cap growth, this is what I was saying, Stephen. It's now looking the best of anything after being kind of the worst for the last few months. So we're actually seeing a reversal. What we did with our portfolio, for those that like follow us closely, we just moved to we moved from like riskier tech like SMCI and Nvidia to something safer like Broadcom, and that looks like it was a good choice, especially risk reward, because Broadcom is doing better at least than Nvidia today, last I checked. But yeah, we're definitely seeing that change, and we're definitely we risk mitigated, right? We ended up being more long than short, but we took some tech names short, like Getty and LP, or I think Getty's actually comms, but it's kind of tech comms. And we also added a Rackspace short. So we definitely played the trend. It's working out well because you actually see small cap growth, small cap value has doing well today. We bet that was just a shorter correction, and we were correct, because we just have not seen, I don't think this AI thing is going away. So even until further notice, we bet more conservatively that large tech would keep winning. Whereas we were very non-conservative in that the last 2-3 weeks. But yeah, I would say the signals today are saying that the market is definitely not willing to give up on the AI boom. So that's encouraging, because we didn't really even change our model portfolio, because that's kind of more of our risk on portfolio. But the newsletter picks these ones, and we're going to, as I said, kind of go through at the end. These are kind of more of our risk off portfolio, and you can see our positions. We only had, we had Google, but we had more of, we had Broadcom, BlackRock, CEG, FANG, so we were very diversified. This is the first time I can ever remember that, kind of tech and comms didn't make up the majority of our portfolio. And, we adjust, and it looked like it was a good call today. Stephen, I'll stop sharing. Any questions on that? I do have to go. Yeah. I realize I have to push something on the back end side, but I'm going to listen to you. Anything? But I might wait for the next topic.
So something I just wanted to highlight today is that in your newsletter, how you were saying the signals we're seeing in the market are so unclear. It's kind of, if somebody says they have a crisp, clear opinion on what's going to happen and how it's going to play out, they're kind of making it up or lying, or just reading into too much stuff because it's so uncertain. And maybe that was a symptom of being the end of the quarter and nobody in the market wanting to make a move exactly. And maybe we're seeing that kind of change today. Now it's the first day of Q2 in the markets, but can we just kind of highlight that and talk about that?
Yeah, and I think that's very interesting, and that's one thing I think philosophically we're very different at Prospero than a lot of other, stock picking or, other companies that I think tend to make everything want to seem super easy. And we like to say we make a hard task of picking stocks easier, and we support investing and trading strategies around that. But that is a huge distinction, where I think a lot of people we'll solve all your problems with these trade alerts. And I just think those people are full of shit. And it's those people, the more the bull markets come, every single time, everybody's confident because their portfolio is going up, blah, blah, blah. But they don't understand that they're just making risky picks. And they're right about the risky picks in bull markets, and they're going to be wrong in bear markets. And I think that's the big thing. Anyone that said they're confident about this little correction, they would have to call exactly when people are going to take profits on those, profitable big tech AI positions. And that's insane to claim that, because honestly, there was a lot of logic that said any time within the last 2-3 months would have been a good time to take profits. And it's pretty much we've talked about this, a game of musical chairs that you don't have the right information about. And institutions do, because they're all talking to each other. They're all feeling each other out, and they're figuring out they have much better information than you do, or anyone you're talking to on the internet does, about when that game of musical chairs is going to end. So I would say the more confident, you often talk to me in these kind of markets, and I'll say when I'm confident, and it's rare, because most of the time I'm hedging. Most of the time, even last week when I was tech heavy, I had, a lot of tech and a lot of tech and comms shorts. And that's why it was a difficult week, because tech kind of was very up and down, and it ended up being like small cap, mid cap tech that got rewarded, and I tend to short those very successfully. That's one of the things that we've done, kind of long large cap value, large cap growth, and short small and mid, like I'd say mid cap especially, tech to hedge. So obviously last week the larger cap tech did worse, and the mid and small cap tech did better, which has been the exception to the rule. And like anyone that claims that they can forecast exactly when the exception happens is an overconfident kind of idiot, to be honest, because anyone you talk to on the institutional side will say they're just guessing. Like the most knowledgeable people will say they're guessing on something like profit taking or portfolio rebalancing. Like you can guess how it's going to be done, but you don't really know because you don't have access to institutional risk models. Do you know who does? The people making these bets and the people talking to each other about institutional risk models, which I promise you they do.
Yeah, to your point, I feel like when I listen to a lot of the smart people talk about subjects like this, they always try to speak and highlight how they talk in probabilities and not in like certainties, to kind of highlight how even if they have an opinion on something, like that's maybe the most probable thing to happen to them, but like they still leave room open for like anything to happen. Everything is a probability. I think we can start turning over to our
I think
next.
to piggyback on what you said there, Stephen, I think that the important part there is that when you think in probabilities, you hedge. And we talk about this all the time. Like you don't go straight long, you don't go straight short, you hedge. Like you figure out like a middle ground, and that's what we do in our portfolio. And one other point that I forgot about this is people ask me all the time, like, what about the hold times? Like, what about this? Like, how long are you going to hold it for? And I'm just like, I don't really know. Like, as we talked about, and I still have to get the numbers for this, for something like SMCI, if you held it from when we first started to now, you would have a great return. But if you bought and sold it each and every time you did, you'd have a better ROI. You'd have a better IRR, internal rate of return, where you're talking about time value of money, cost of capital. Those are difficult topics to teach in a short window. But anyway, basically what we're talking about there is like, if you're doing it the right, correct way, as I'm trying to model, like you don't have a specific hold time. You're checking QQQ and SPY net option sentiment on your stock. You're checking sector levels. You're checking market cap levels. You're aware of all this stuff, and you're adjusting and hedging on the fly. That is the correct way to trade, or even invest in risky assets where you're holding single stocks, right? That's the correct way to do it. And so we're modeling the correct way. Whatever you take from that is up to you. But generally, if you hold our longs and short our shorts, like you're going to do very well. Like you might not do as well as us because you time it, but that's what we're exemplifying, right? We're exemplifying like the real best practices on what to do, because the real best practices are what to do. And what you see, and why 90% of retail investors lose money on options, is like you see a lot of overconfident people in bull markets, like talking about how much they've won, but you never see them talking about their losses. And when you do, we saw another startup that was in our same space that just whitewashed the whole thing. They lost more money than they made in the boom when they thought they were really smart and they were selling these like creator things. But then all of them got hammered, and they just pretended like that didn't happen. And they made a bunch of people pay for these like faulty trade alerts. And you just see that all the time. And it's people just capitalizing on boom times and not reporting their losses when they don't. So like those broad numbers, like 90% of retail traders lose money on options, those are the numbers that should matter. A number that should matter even more to you is about 80% of hedge funds don't beat the market in their investing portfolios. Like people have to properly understand what they're up against to really understand how to do well in the markets. And everybody I see on the internet, almost everybody talks about this as if it's easier than it is. It is not easy. So I think that's very important, especially as what it looks like is going to be another good year for the market. You just have to be very careful, because if you are probably some of the unfortunate people that like got into SoundHound when it was approaching $10. Like it might be a while before you make that money back. And we warned about that before that happened. And sorry to pick on SoundHound. I actually think it's a good long-term company. It's just way overpriced. And people confuse those things, right? And let me just make it very clear. Like, even if SoundHound is a good company to own right now, long term, I think it might still be even overpriced. So the question isn't like, will SoundHound do well long term? I think it will. The question is, why would you want to own it now when there's companies that are going to do well long term and short term, like Meta, like Google, that I think is priced at a very attractive valuation right now, especially given the fact that it could have a huge Apple deal on the horizon. So I think that all of this is like very important. It's important lessons, and I kind of like rambled more than I wanted to start this off. But I think that's an important thing to take to heart in terms of like how investing is taught and how it's like realistic. And I think just to drive that point home a little more, there are very skilled technical traders that could do very well with technical signals because they're watching the market the whole day. I also see a lot of people just like learning technicals that don't have that amount of time to put in. And I think that's like kind of a difficult part about it is like, yeah, you could follow someone's trades and not understand the technicals quite as well as they do. And you're not really learning to invest on your own. Like we really want to teach people how to fish. All of the signals that were created are with that in mind.
I think that's all great information, and I'm so happy we have a lot of viewers in here to hear it. And if you're in here and you're watching and you liked our first 20 minutes, be sure to like the video and comment what your favorite part was so far. But we'll get into our next story, and this one affects me personally, unfortunately, possibly as an AT&T user. I don't know yet. Maybe they'll be contacting me shortly. But they leaked 7.6 million of customer data into the dark web. What they leaked includes basically everything from your name, your home address, phone number, date of birth, social security. And this information was made public over the weekend, and the stock is barely down, not really moving that much. Kind of, I don't know, it highlights how the market maybe doesn't really care, or maybe it even doesn't know what to price in yet with this story. Maybe there's still turns to be had, but it also highlights the importance of cybersecurity going forward, which we've kind of talked about before. And lastly, before I spin the story over to George, it's crazy to me. Like AT&T was once the biggest company in the world, and kind of how far a fall of grace that they've had over the past decades, like 4 or 5 decades.
So it's really interesting that I kind of consider this as one of the like there's many problems that there's never good solutions for because the right incentives, nobody in government is trying to hold industry honest. And like I think the most obvious example is what's happening with our environment. And we don't really need to get into it. I think I think there's fair I think there's fair points to be made both on the side of like maybe some of it is like overblown to villainize one side in terms of how quickly and severe it could happen because like I think it's kind of difficult to model that. We don't have like a lot of precedent for that, although there are definitely signs that it's accelerating. On the other side, I think it's hard to argue that we're not seeing like changes, especially when you look at things like hurricanes and but anyway, while I set that and I try to like set like I'm not on either side here. I think it's very similar with things like hacking. Like there's objectively irresponsible behavior going on with these companies when they don't protect your information enough. It's their job to protect your information. And then when it happens, we kind of just like throw up our hands and be like, oh well, they got hacked. Like sure, we can leave, we can go to another service, but a lot of the times these contracts are like locked in, and it's just like the lesser of two evils is like, is it really worth it to go through a bunch of hullabaloo to get to Verizon when it's like, who even knows how much safer it's being kept there or whatever. I would say like Verizon and AT&T is probably a much better bet than Boost or Sprint or whatever, or any of these smaller providers. Cause just like the more money that you have, the more you can commit to cybersecurity. But there's another side of it that is just like, well, the smaller you are, the less interesting of a hacking target you are. So we don't need to go too far down that road. But the main point that I want to make is that, if there were more fines for these leaks, I bet companies would put more money behind it. And there's just like there's not enough attention ever paid to corporate responsibility. And I think a lot of that lies on the government. And just to make the point even more in one other situation, it's like all of these bailouts that we see in finance, like for all the song and dance about like you shouldn't do that, Wall Street, blah blah blah, greed, we never actually see the government, and like we've gone through so many cycles of this, the government putting the proper teeth in these regulations that don't make institutions gamble. There's never any punishment for these institutions gambling, so why would they stop gambling? And I think it kind of always falls back to like our government not properly disincentivizing industry.
So I just want to swing back to a comment we got from Topher before we change subjects right there. He was asking, are you talking about Goog or Google for the tickers? And I believe they are the same thing, if I'm not mistaken. It shouldn't matter, right?
They're not the same thing.
Oh, okay.
One is the holding company, and the other is more of the operating company. But it is very confusing. And the reason that I like Google, GOGL, is like right now you can see it's got a higher net option sentiment and a lower market similarity. Basically, like as we say, when the market similarity gets too high, then you're taking on too much single stock risk relatively. And the Goog with the L has an 88 market similarity, and the other has 92. It also has higher GOOGL has a higher net option sentiment. But like the main reason I prefer GOOGL is it has a lower market similarity, so there's more reward. And we've explained this, like once you get to 100 market similarity, there's almost no point in owning the single stock, because you're basically saying like you expect it to perform as the market does. So why would you take on the single stock like news event based risk of that high like max market similarity when you could just buy the S&P at that point?
All right, so that's some good clarity. Hopefully that helped you out, Topher. I just want to finish off this first topic we're talking about with AT&T and kind of just see if there's any of these cybersecurity companies, because there's a lot of them currently in a best position to like take advantage of the opportunity that we foresee happening as it's needed more and more with all the companies.
And just as we're seeing that, GOGL passed SMCI for the day. So looks like we pulled the right levers today.
Topher said, "Cool, thanks." You're welcome, Topher. Glad to help you out with that.
Sorry, did you ask me another question? I was like looking at this update and probably spacing out a little too much.
Yeah, no worries. I was just asking to finish off our first topic about AT&T and cybersecurity, like if there's any cybersecurity companies that you think are in the best position to take advantage of the opportunity that we see happening over the coming years.
Is this true? Is this our cybersecurity topic, or is this different?
It's kind of just finishing off the AT&T cybersecurity thing.
But don't we have a specific topic on cybersecurity, or am I mixing that up? Okay.
No.
Yeah. Anyway, we definitely like, I mean, two names above the rest. I'm just going to check them out right now in Prospero, and I think people do like when I like kind of narrate this. So I think let's look at I think CrowdStrike is our favorite, but we'll take a look. Yeah. CrowdStrike's got 89 upside breakout, 4 downside breakout. Net option sentiment recovered a little bit, like to 67. But I think this is our favorite because of good profitability plus growth. And a note on like AI and cybersecurity. Like one of the things that we've talked about is like as AI becomes more prevalent, the main hacking systems, the old ones were like brute force, kind of roomfuls of Russian hackers. Now AIs are kind of the best tools to hack because they can like brute force. They could try a bunch of combinations a lot better than like a room of people, right? So the more you have AI as an intrusion mechanism, the more you need AI as a defense mechanism. And as AI becomes more prevalent, the more you need to spend on cybersecurity to get the cutting edge stuff. So that's why like we're seeing a lot of these like, CrowdStrike, PanWest, move a lot with these secondary, kind of like the secondary AI offerings. So now let's look at Pan West, which is a favorite because Nancy Pelosi just picked up, but it's not as like it's only 55 upside breakout, not as much as CrowdStrike's 89. Looking at CrowdStrike, I might actually look at that as an ad. It had a pretty good, a little lower net options end of it that we'd like. Pan West is a good second choice, but we don't like that as much. Zscaler is something that like used to do well in our signals, but kind of took a big ZS I think is the ZS. Yeah, it's somewhere in between 60 upside and 29 downside. But yeah, it looks like CrowdStrike's by far our favorite in that space. But just generally, I think we're talking about a really good long-term opportunity with cybersecurity. I think CrowdStrike is by far our favorite there, as we just discovered.
Yes, and it's kind of ironic to me because last week we talked about, the antitrust stuff that was being released in Europe or announced in Europe, and we kind of highlighted how Microsoft avoided it for the time being, and now they just announced that they're going to unbundle their Teams and Office globally to over antitrust concerns. And this had already been done in Europe, and now it's just being launched. It's being separated globally. And then, a week after we kind of talked about it, how they avoided it, they're doing this. But I wanted just to highlight that and say, like, is it impactful for their business that they're unbundling these services?
Yeah, but I think it makes the point. I think we talked about like one of the ways that Microsoft like stays ahead of the curve, or like one of the ways they're very different than Google and Meta and even Apple is they're a B2B company primarily, right? So like if you look at the comparison of that, like anyone we talk about like all of these businesses that just basically are like in for better or worse the Microsoft Office suite, and it would cost them way too much money to change. And to be honest, there aren't like fantastic alternatives. Especially as we talked about my frustrations with something like Google Sheets, which does not even use all the same, all the same methodologies, or all the same like hotkeys, especially for an expert like me that uses it. But anyway, even in looking at those businesses, it's very easy. Like who's doing the lobbying? Large businesses, right? So large businesses are going to advise wherever they are, the Microsoft Office, especially if they're using it, on how to stay ahead of the curve. Because the last thing they want is their provider of Office services to, be behind, be under the gun, have any uncertainty around it. So you actually have situations there where, you see this play out. That's why, Microsoft tends to, do much better in these situations because they basically have people giving them tips and staying ahead of the curve because they're B2B. On the other hand, like, it's a complete opposite. Like, while Meta and Google are often like kind of at odds with their consumers. And not only are they at odds because people kind of feel like, a lot of the times more data is being taken from them against their will than they want. Those people that are there are generally kind of the opposite of B2B. They're generally like very uninformed about what's going to happen in the government, and whether their complaining will actually fall on deaf ears or whether something will actually happen. But the point is, even if they weren't at odds with their customers, which they often are, like those customers have no idea when government is actually going to act, because a lot of the times it's not really organized. And the last thing that these local governments or national governments want to do is give Google the heads up or Meta the heads up, because they don't want to be viewed as like looking at like they're in concert with the people that people are pissed off at. If anything, they want it to come as a surprise. So and have Google and Meta or whoever be unprepared for that, because then it just like looks like they're actually doing their jobs if they do choose to do that.
I think that's interesting to hear because people often think about the Magnificent Seven and all of those stocks so similarly, and to highlight differences between their businesses, and especially at such a scale of like the government and the user base. I think it's interesting to hear the different risk factors going forward of all those different businesses. And obviously, Tesla's got its own problems, and Nvidia has its own problems. So it's easy to lump all those stocks together, but they have very different problems and businesses.
Yeah.
Um,
And I think it's always like, and I think that's kind of how we show, like how we always like to teach it here, right? Where it's just like, yeah, we have unified signals, But always on top of that, like, it's the same for every stock, but always on top of that, we like to layer logic systems, sector-based, business, traditional value investing. And, we do that because we think both disciplines are very important.
Yeah. So spinning off of our opening segment when we were talking about the market, and actually we kind of looked at tech, and large cap tech was doing better, but I kind of wanted to look out and look at alternatives, because we were saying that the signals aren't showing a clear direction, and kind of highlight big bank stocks because they're going to be the first stocks to report. I think they start April 15th, so it's only like 2 weeks away. And they're all trading so cheaply just based on the PE metric, which I know you've talked about how you have to look at a lot of other stuff than that. Um, but I wanted to highlight them and throw them out there as maybe something that people could possibly look at if they're looking for cheaper or more value options in a market that might seem like some stuff is getting kind of overvalued. Um, I know you liked materials. Topher has commented asking about energy, so maybe we could kind of just go through the gambit of more value areas of the market and kind of highlight which ones look interesting.
Yeah, as you were talking, I was kind of updating our sectors for today. Um, and I think you have a good point. I think we should pull in. I don't know the best way to do this, but I would love. That can't be right. Oh, I see what happened here. Sorry, I was just getting a good update, all this stuff. Yes. So I'm gonna actually pull up my screen. I mean, it might be better. We were going to talk about banks, right? I think it's honestly, I think it's better to do this within the context of the model portfolio when I'm sharing my screen. We'll come to that when we get there. I just don't think it's as good of like, I would share my screen again. And I think we should just get through. I honestly think we should just get through the topics. And like, I want to talk about bank stocks specifically, right? That's the segment.
Yep.
And then, yeah, and then we'll talk about the rest on the other side. Okay.
Okay.
So yes, essentially what we're talking about in terms of the bank stocks is that, like, how we're always talking about on this on basically like how we like to make sure we are getting the right information about what institutions are doing as a base, especially in the options markets, because a lot of the time they're dealing with just like different sets of information, news, access, all of that stuff. That's true for any stock. Why we generally don't like to encourage retail investors to speculate on banking stocks is there's another level where, to properly price a bank and understand the potential profits, you need to know the asset mix of the bank. And all this is public information, but much like 13Fs, it's trailing. Like, you're often getting old information quarterly on the actual asset base. And the really perfect example is kind of what happened to Silicon Valley Bank last year. Is like, unless you knew their bank, which we've always told, like what you said, like the first people to really figure out were other institutions. Why? Because other institutions do have special software, like we've talked about it, whether it's SecDB for Goldman Sachs, Quartz for Bank of America, Aladdin for BlackRock, all of these like funny little AI named systems that are basically universal securities databases built to look at a bank's assets. And they have better access to live information than we do and figure out what risk they are, right? All of those banks that collapsed were taking on riskier fixed rate assets when interest rates rise, and they were basically, hedging the market with their fixed rates. The relative value of those fixed rates fixed to lower rates was worse. And that's why they collapsed, because they did something called marking to market those assets that were worth more. So they basically had to take a loss on paper that hurt their capital position, their debt, things like debt to income, everything like that. And then what's worse is when people found out they were in trouble, they started to pull out their deposits, which makes their liabilities go even farther above their assets. And that's how these places get in these death spirals, right? But the point being is, like, our information is old. like even someone like me is like, I could build models to properly assess the risk, even though I'm still dealing with the problem of dealing with older information. Because I'm not going to go to Bank of America or Silicon Valley Bank and whoever and be like, hey, can I have live access to your balance sheet? You basically need to be doing business with them, like another large bank, assessing counterparty risk to be able to have access to that information. So that's why bank stocks are an added layer of abstraction. And even just looking at it right now, I couldn't tell you what bank stocks are better or worse than others. Mostly because I haven't done that analysis. And, I don't really know which ones have the most exposure to consumer credit. Like that's an unknown. I don't really know which is in the best position to, I think what part of this question was, is capitalize on falling rates in terms of the interest rate position and bets of said banks. Those are just two huge examples that would diverge the valuation considerably. And as I said, even if I set up the equations to properly assess those, I'm dealing with older information, like relative to the banks. So we always say, who are you up against, right? You have to make that exception. Who are you up against? What kind of angle do you have? And bank stocks are always where you're up against the most, because you're betting against the normal institutional information that they have better than you on any stock in terms of just access and data. But you have the added risk factor of all these large banks that are betting for or against their contemporaries having better, more live information on the asset positioning of those banks. So you're really fighting an uphill battle when you do that. But when we do make bets like we did on BlackRock this week, because it had very clear technicals, it was doing very well in our signals, better than bank stocks, do traditionally in terms of how it lines up and net option sentiment, upside, like all that stuff. But it's just like, we can always wrap our heads around betting on BlackRock. We can always wrap our heads around betting on Goldman Sachs or JP Morgan, because those are kind of the class of the banking world, as I'd estimate them. So it's like, why am I okay to bet on them? Is like, I'm universally fine if the signals look good to bet that those three firms are putting themselves in a good balance sheet position, because they're assessing the balance sheets of others, they're forecasting their assets well, they have government connections that are helping them. In the case of BlackRock especially, they're incredibly well diversified. So that's why, if you're going to bet, like, to give you a nice end here, if you're going to bet on a banking stock long, I short like smaller banks all the time that I don't have confidence in. But if you're going to, but like not as much this year, but if you're going to bet on a bank long, that's who you bet on. Like, you bet on one of those three banks, in my opinion, and if they look good in the Prospero signals. But I would say, unlike other things, if net option sentiment is like 60 or above for any of those stocks, and upside breakout is just greater than downside breakout, and you like the setup, there's good trends on those things, there's a lower, I would say, check that you can make based on banking stocks just traditionally running lower in those key signals for us.
So one of the things that I wanted to follow up on with that is, you talked about how the information that investors get just lags behind what's actually happening real time so much. Do you think that needs to change or will ever change in the future, or are investors always going to be behind the eight ball when it comes to getting information like that?
They're always going to be behind the eight ball, and we talk about this all the time. And I'll just do a quick version of the analogy that we always use, when it's just like, when people say like it's unfair, right? Well, life's unfair, right? I don't see anyone complaining about not getting a first class ticket or a private jet flight when you don't pay as much. And trades are the same thing. That's really as simple as it is. Like, people's trades are getting transported. Richer people's trades are getting transported in a better transportation system, with better information, easier to stay ahead, better weather information, to expand on the analogy. Like, there's tons of stuff, like in the case of like a private jet, they're dealing with much more advanced weather systems in a lot of situations. So, and especially smaller planes have higher risks, everything like that. A lot of the times they're going to be further automation on these more modern planes, all this stuff, but not to get into a big plane discussion. You're probably, we're going to make a joke about this, but you're probably not dealing with a Boeing situation where there's faulty manufacturing either. But yes, like, unless you have millions, tens of millions, or certainly billions of dollars, if you want to take it to the extreme, your trades are not going to be transported by the same system. You're not going to have access to the same data. And that's just like the reality of the world we live in. It's not just finance. More money gets you more access, gets you better transportation, whatever you want to do for the thing. So I don't know why people are always whining about this, because like no one ever promised you a fair market. Like one of my favorite things in terms of politics of this example is like when the Democrats were basically sued in Florida over how they handled their primaries. Their official defense was that like when they said that they basically like were treating Bernie Sanders unfairly and giving like Hillary Clinton advantages, their official defense was, we never promised you a fair election. That was their official court defense. You can go look it up. They said, we're not legally obligated to do that. So you could say the same thing about trades or whatever. Nobody is giving you no one is saying you have a legal obligation to get better high frequency trades or payment for like order flow situation than anyone else. No one promised you that. It's not in your terms of service. So that's going to put you at a disadvantage. And the sooner you realize that you're at a disadvantage in life and there are ways to get around it, like we show you with Prospero, ways to stay with institutions instead of behind them, the sooner you're going to do better. I would say emotionally and with results. You're going to have a lot of letdowns in this world if you're expecting fairness. And I don't know how people find themselves let down by this time and time again when it's been this way since the Great Depression. Like it's always been this way that like people like because of they can control legislation, because there's so much money involved, all this stuff that Wall Street is going to have different privileges than other people. And that exists just like all around. Like, why is it that people get angrier about, Wall Street having different like trade flow than they are about Lindsay Lohan not having to deal with normal laws when it comes to her driving drunk? This exists everywhere in society where it's just like laws are not applied the same way to the same people. And there's a lot of like loopholes. And it's just like, you're not going to get very far whining about it. You're going to get a lot farther just accepting it and not being bothered by it and figuring out what you can do to succeed given the unfair landscape that you constantly face.
Mm-hmm. And you're talking about the Democrats. We didn't promise defense in their case, and maybe Sam Bankman-Fried should have tried that for his defense. We've been covering the story, and it seems like it's come to a bit of a close here. He was sentenced to 25 years in prison, and he has to forfeiture over $11 billion to the U.S. government. And the quote who was judging the case, the quote from the judge in the case is pretty crazy. He said, he never heard a word of remorse for the commission of terrible crimes from Sam Bankman-Fried, and he said he poses a great risk in the future. And Sam Bankman-Fried is pretty young, and if you think he gets out of jail or prison a little bit before this final like 25 years, I don't know. Is Sam Bankman-Fried going to try to make a comeback in the business world?
Yeah, I mean, I think that's like one of the best understatements of the century, like that it's risky. That's like saying about Boeing planes that like you're probably in good shape if you get on it. It's like, yeah, probably in good shape, but it's a little more than calling it risky. Like, but no, I think it's super interesting. I would like to know how much of his total net worth that fine is, because like one of my big gripes about Steve Cohen is like when he actually went down for his securities violations, it was like a fourth of his net worth. And it's just like, okay, you're basically saying acknowledging that like some of these gains are ill-gotten, or at least an unknown amount of the gains are ill-gotten. And it's just like, you think that's actually a punishment to like do like a fourth of that fortune? Like that didn't burn him at all. And he owns the Mets now. He's got a good life. He's got a good life for a convicted criminal. Like, or I don't know. I actually, maybe convicted is wrong. No, I mean, because he's settled. I don't know what's the word, like guilty criminal. I don't know what the official thing. I don't want to get sued. I take back the convicted part. But I think he acknowledged guilt. Is it? And it's like, if you're acknowledging guilt in the situation, I would think that there would be more done to actually like have him have like a worse life than all the people that haven't been guilty of like pretty serious crimes. Not that I think crime should be like, I don't think punishment should be cruel or unusual, but like, yeah, I think he's living a little too well for someone that like pled guilty to a serious financial crime. But again, that's just kind of how it works. But yeah, maybe for next week you could research like how much of his net worth that is, because if he's living like 25, like going to prison for 25 years and is then reemerging to a nice fortune, that's kind of like a better life than a lot of people get in America.
Your Steve Cohen point is so interesting because it relates just to like the Meta Google slash Microsoft story of who the customer is. And I think Steve Cohen, he got charged and it was like within Wall Street. He didn't actually like screw over individual people, right? Essentially, whereas Sam Beckman-Fried like stole money from people. So it's like the business versus the individual customer affected, the same way Google, Meta, and Microsoft, and like the stuff we're seeing going on with how the government is treating those companies. I think it's pretty similar, no?
I think you're hitting on the wrong point. I think generally, like if you think that like all the people that like get billed out in companies, it's always corporations that get billed out, and it's rarely people. So I would say like screwing over people doesn't get you in. If there's one rule that I always say in legislation, it's like you don't screw over rich people. That's why Bernie Madoff had the book thrown at him. Like the only thing that really gets you in trouble in this country, I think, is screwing over rich people. But the interesting thing about Steve Cohen is kind of like using advantages in the market. You're kind of screwing over retail. You're kind of screwing over the people you compete with. But like my knowledge of the story, and keep in mind this is secondhand information. I'm not saying that this is the real story or blah 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 or whatever. What I've heard secondhand is that basically like Wall Street's kind of a cabal, and the general rule on Wall Street is there are no rules. Like you do what you want, you face the risks, you don't embarrass your fellow people on Wall Street by being like too extreme or whatever. And that's the general unspoken rule of Wall Street. And if someone pisses you off, like the general, and like anyone that hasn't watched Billions, I'd say you'd learn a lot about this mindset. The general thing is that if you there are no rules, and if someone fucks you over, or you think they fuck you over, you get them back on the street. You get them back in the market. You short their positions. You screw up their investment. That's kind of the unspoken. Like baseball has a lot of unspoken rules. I think Wall Street has a lot of unspoken rules, which is like the same kind of rules I actually try to teach you. It's like don't whine. Like make your plan. Like nobody's gonna respect you if you whine, and you're not getting very far by like complaining, whining, whatever. You face the reality, and if someone gets you, like you get them back. But what I would say is that I'd say what Steve Cohen did that was kind of like what got him in trouble with the rest of his Wall Street compatriots, I would say, is he was kind of showing them up, right? It's kind of the same equivalent of a baseball celebration, which is why I use the analogy where it's like you're allowed to do like a home run trot or like whatever, but if you get too extreme, you piss off you've broken the unwritten rules if you like celebrate too much, and then you might get hit with a few pitches or whatever. And I think that's the same thing with Steve Cohen. He was, I think, flaunting his advantages too much, and people knew he was like kind of taking these things to the extreme. Like what he ultimately got caught for is a pretty extreme version of like Wall Street, greed and corruption, I would say. And I think that's what happened. Like eventually people were just like, because to be clear, like there's too many Wall Street veterans in the SEC and the DOJ, blah, blah, blah. Sometimes people retire to both. You on Wall Street, you retire to like a cushy government position. You look at the Fed, it's obvious, it's like frequently a Wall Street. There's a lot of like intersection between Wall Street and the positions that monitor Wall Street. And at the very least, even if you're like a career person in the SEC, you need sources in hedge funds. You need like information from that. You need diplomatic relations, right? So the average the average person at the SEC is probably going to be a lot closer with someone on Wall Street than some average retail investor, just probabilities wise, right? So basically the point I'm making is like, unless you've pissed off enough of your contemporaries, as I believe from what I've heard about Steve Cohen, he did, by being a little too extreme with your success and your flaunting, and it's generally whatever goes. And to tie home like this to like a lot of like what I always say to retail that takes it very personally and thinks like hedge funds are against them. No, hedge funds are not against you. Like what is the case is if they could do something like with AMC or any like SO like Sound or like any of these meme stocks. They're very much interested in easily brainwashing a lot of you guys to just follow a script, which is what you constantly see in meme stocks, literally the same script. You can go look on if you want to see what's going to happen with AMC in the next few years, go look at what happened with Bed Bath and Beyond and how that played out, and basically what people were saying all the way to the bottom, all the way to bankruptcy, even through bankruptcy. People were saying, don't sell your shares. You're going to get a big windfall. You're going to get the squeeze, like still. Or like you're going to get a big, like we're going to get a lawsuit, blah, blah, blah. It's just such bullshit. So yes, Wall Street, if there's low-hanging fruit on manipulating a lot of you into doing what they want, they'll take that. But you're not their real enemy. Even anything that like low-hanging fruit is all about them just like getting you to juice their trades to give you more ammunition against other institutions. The only thing that institutions are worried about is other institutions. You are a blip on their radar. Like I think it's like 90% of stocks are controlled by like institutions or like the 1%, some extreme number like that. So even if you just look at those numbers, they care about size. They care about size. They care about who they're up against, because generally, GameStop was an exception where I think retail really snuck up on them. But generally, and one of the things that we always said about GameStop, we said it last week, is like even then, retail snuck up on them, but it wasn't until institutions piled in and institutions did things like bought a bunch of shares like BlackRock did, lent them out at very high interest rates and then yanked them to form a squeeze. Like that's what happened. And you still need institutions. Retail can't do it alone. And anyone that thinks retail can do it alone is absolutely fucking insane and a liar, or both. But yes, that's like the best way to kind of look at what's going on there. And it's just like, don't take it personally. Just understand that they're fighting larger battles, and that does give you some examples where it's that does give you like some basis where it's just like look, that allows you to do like kind of the strategy that we teach, where you can sneak up on them because they're not looking for you coming behind their backs and like drifting off their trades. They're not looking. So that's the best strategy any retail person can do. But like all of this, like us against them, blah, 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 like this like warrior mindset is just bullshit. They don't care about you. So stop caring about them, start making money. And you're not making money in these failing meme stock trades.
Amen. Just start making money. Everybody in the market is, at the end of the day, just trying to make money. We have one story left to cover before we'll do our switch over. And if anybody in the chat has any questions, feel free to comment them. But it's kind of just highlighting, you talked about the Fed. They released their 2023 income, and they lost the most money they've ever lost, $114 billion. And maybe they were just supporting the markets, but I don't know. It kind of shows the state of the current business and government landscape, huh?
Well, if there's one really disappointing thing about government, and for people that watch my live streams, I know there's a lot of disappointing things, is there used to be at least one political party that was kind of being mindful of spend, but now neither of them are. Like Trump spent more than Obama, for anyone that like wants to think that like Democrats are the spending party. Like everybody spends now, both sides, and they don't really care. They don't like, nobody seems to care about budgeting at all. Like, and we have these big negotiations, but then we always just like spend more, and we never really make, honest cuts to the budget. And it just seems like we're seeing the same thing in consumer credit right now in America, with like people just like being like, oh, whatever, we'll just rack up debt. Maybe the government will bail us out. And the government's being like, oh, yeah, we'll just rack up debt. The next government will probably bail us out. So it's like everybody seems to have this attitude, and eventually, but we're going to pay the piper. Like we've seen the U.S. government debt like downgraded, and like, it's probably not going to be too long until we see another downgrade, because that's what happens when you just keep on racking up debt. Like your spending decreases. Like eventually you pay the piper. Everybody with debt always has to pay the piper. And it's kind of funny because, there's kind of bailouts. Oh, Steven, do you want to, like, for that question, do you want to
I'll link the video.
Share a short. Yeah, we made a little short about this, about what things to use, and probably better for people to see like the brokerage around that. All right, anything else, or are we going shifting to the portfolios?
I think we could do our switch over. I'll hang here with chat, get that video for Spiky Dude, and we'll see you on the other side for the model portfolio update.
Yep, we're gonna do some. It's gonna be an interesting update today, but yeah, it looks like we were on top of the right things today. Our longs are some of the few good longs. But yeah, we'll see you guys on the other side. You're gonna share that video, right?
Yeah, I got it.
But you can share it and also talk people through what we said while I make the transition.
Yep, we'll do. Okay. Okay, so Spiky Dude, I'm sharing the video right now. But in the video, we kind of highlighted, or George talked about how Fidelity, Vanguard, Thinkorswim are his favorites. I think in usability, and also, I think one of the actually in that video we also talked about the brokerages that he dislikes the most, which would be Robinhood, Webull, 212 Trading, or any other startup investing app, basically, because they they do pay for order flow and they let institutions kind of go in front of the retail investor. So I think Thinkorswim was the best of ethos and usability he was talking about, and Fidelity and Vanguard were kind of just like the best ethos ones, but maybe a little bit less on usability. But he still liked those. Do not recommend Robinhood or Webull. It also mentioned in our last live stream. You're welcome, Spiky Dude. Spiky Dude, what's your name? I would like to call you actually your name and not Spiky Dude every time you comment, because you're here a lot. So I'll remember it. Just if you want to share it, just share it. Feel free, and I'll call you that from now on. And if anybody's new in here, I can kind of just give you a rundown. Saul, all right, I'll call you Saul. I'll remember. Better call Saul. But if anybody's new in here, what we're going to do right now is we're going to get into the model portfolio update, where we look at individual stocks and kind of make live changes to the portfolio based on what we're seeing in the signals and how the market's moving. So you'll get like an in-depth view of that. It's pretty interesting. So we're going to be getting into that. And if you want to look at any stocks, feel free to comment them. Let me get an update on the QQQ and SPY. When we started, QQQ was 47 and now it's at 41. So it's been dropping over the past hour. Actually, that's a pretty decent sized drop. And the SPY is at 50, and I believe it was at 51. So kind of almost the same. Not much of a change there with the SPY. But that's interesting that the QQQ dropped decent amount over the past hour. It's also now negative. So we see the actual market moving the way the signals are kind of showing. So
did we get a real name for Spiky Dude? Is that what just happened?
Yeah, I just said he's sitting here so much. I'd rather just call him his name. And not
it feels weird to call him Spiky Dude. I forgot what his other alias was too.
Yeah, he had a different name on Twitter, but it's Saul. So we have Saul from now on. So better call Saul.
Nice to officially meet you, Saul.
I just gave everybody an update on QQQ and SPY. It kind of looks like they're dropping in the signal slightly. QQQ was down to 41. It was at 47 when we started. So things might be looking a bit less bullish.
Yeah, it opened at 48. So that is not a good trend. We ended the week a little more short than long, so we anticipated that. Yeah, I mean, SPY is just doing it. Damn. One interesting thing is we have downside breakout. Really, if you look on the anyone that looks on the app, it's actually a pretty interesting pattern. We have downside breakout going up pretty much exactly. Wow. Upside breakout leading. I wish there was a way. Is there a way for us to? Yeah, I'm gonna just pull this up because this is a really cool pattern that we miss, because I typically look time series on. I'm gonna look at this more now, but this is probably the first thing that we're going to go through, because that was an opportunity. God, I feel like you guys all using the app, you failed me by
They got to give you the
not
heads up.
alerting. Yeah, we I can't look at everything. I'm pretty busy, and I got a lot of stuff to do. You guys as a group could help me out a little. No, I'm just kidding. I thought we'd be doing better on the model portfolio today. We're still above 50. Okay. Anyway, we're about to make the transition. I am going to get everything set up, so we have it in place. Oh yeah, and we're gonna kind of do our morning update on the investing letter, and then we're gonna do our morning update on a trading letter. We do have. I'm just going to get this all set up. One of the things that we got a question of, are there any lessons from previous pullbacks? I'm kind of going to talk as I do that. I think the lessons on the previous pullbacks, I think that's a really tough. I think that's a pretty tough thing to do, and I'll tell you why. I think the way I look at the market at any given time, this is what I was saying like earlier. The way I look at the market at any given time is like I'm just trying to like get a picture based on like, and I think a good maybe parallel is like some of the best nonlinear models for the stock market are things called LSTMs, which are long-term, short-term memory. And basically what LSTMs seek to do is weigh current information more strongly, but not ignore older information. So I think that's really how I look at things. I take a fresh look at everything always. I see how the signals are doing. And then I'll layer in like, okay, what can I draw from in a non-cohesive way? What can I draw from examples? And I think a really good thing that you could say that I can draw from in like other down cycles or things that we've seen, and I would say even more recent memory or historical, is just kind of an idea that sometimes it's just very simple lessons, and I talked about it there. It's like the what goes up must come down, right? And like as I've said, it's really important to us to keep a current view, but part of it is being like defensive. As we, especially, and I think the way we started this week is a perfect example. Like QQQ net option sentiment was in good shape. SPY net option sentiment was in good shape, but we correctly took a more defensive stance based on some current new information we looked at, which was just that large cap growth was taking a hit, as well as, just historical patterns of knowing that like, okay, large cap growth is taking a hit, and like it had a huge boom. So it taking a hit is very logical. And also it's very logical is like, we don't know when that hit is going to end, just as we didn't know when it starts, because it's basically people in institutions that are talking to each other and having these conversations being like, market's a little overvalued. How nervous are you? And if you have people around you are like, no, green light, we're in, versus being like, we're starting to get a little worried. Valuations are getting too high on these like large cap, they're all saying that to each other, and we are not getting that story, right? Because if there's one thing, there is some honor among thieves. Like there is something in terms of like, you can never really trust anything completely about what people are saying on Wall Street, but there's also some camaraderie and friendship. And I have plenty of sources that, I obviously give my honest market view, but I have plenty of sources that I'll talk to that'll give me their very honest market view. And I believe them when they tell me that, because we have relationships. Some of them are, family members or close friends, and we have relationships outside of Prospero. So I think that that's a really important thing to remember. And also why it's like, I give the musical chairs analogy, because even someone like me, like just to use like an extreme example, let's say you're the chief investment officer of JP Morgan, and you have a relationship with the chief investment officer of Goldman Sachs, right? And you're being really honest with each other about how you're feeling about that game of musical, about the music stopping, because you're going to start to short the market. You're going to start to take profits. You're going to start doing, various other hedging strategies, et cetera, right? Because even if you're not exiting your positions, you could be buying a bunch of put options that other institutions are going to have to hedge the downside against. There's tons of different ways that this can happen, right? So I hope that helps you, Saul. Like there's a lot of layers to it, but to put a cap on it, the way we approach this stuff is first always looking at the data. I'm teaching people to do the sector analysis right now. I'm teaching, as I mentioned, both an intern and then someone that's like, kind of a more advanced retail investor and also a writer. And like one of the things I always say when they're asking me like, how are you making these determinations? I'm just like, it really starts with the numbers. Like a lot of what I'm writing is just reporting what I'm seeing. And as we've said, as we have these conversations and I explain like some things that they don't know that I know, that like I'm looking at the 1 month change more than anything, but like the 1 week and the 3 month are important supporting characters in that, because that's what like situate those numbers well. Like even the comment I made in the newsletter this week where I'm talking about sorry, one second. I have 3 monitors, and sometimes when I'm streaming and doing all 3 monitors, I get some latency. So yes. So basically what we're looking at there, what I'm looking at is, yes, I have some experience in interpretation, but at the end of the day, I'm just like interpreting the data, and we can actually transfer this to the portfolio now, because like it's a very good way to like drive this home. Like what I mean when I'm interpreting the data, and I actually want to go back and just drop this in before I really start to do the update. Like I'm going to open TradingView. I'm going to get us all ready. I'm going to open Thinkorswim. Sorry, before I just do everything. Even though I have my portfolio in Thinkorswim, I still Thinkorswim always wants to update, but we need to have the newsletter for this week to actually like get. I wonder what we can do on this. What can we do? I think this will work. Sorry, I'm just getting it so it all posts in one place and we can just like look at this side by side. Ah, perfect. Look at us go. This is going to be very educational. Sorry, I'm just getting everything pulled up. We're actually going to look at both the caps and the sectors side by side. Oh, and you know what? Oh, we'll get a live look. All right, we're finally ready to share. So let's go in here. So let's take a look at sectors first, right? And what are we seeing? One of the things is we're actually seeing that tech is looking better on the 1 day than it was on last week. And we see like consumer discretionary might be something that we want to load up. That's what I'm seeing. It's accelerating from last week. This is current. This is last week. So it might be something we actually want to load up on more. And, it looks like real estate is continuing its, for lack of a better word, schizophrenic up and down nature. We did see correctly, like I got a little more nervous about industrials. That looks like it was the right call because it was still at 0.2, but it's like accelerating. Consumer discretionary looks like it's accelerating. Utilities, that's not a big enough sample, but it does look like it's slowing down as energy stays strong. So we might look to acquire more energy picks as we go in, but I don't think we're going to adjust too much. But we are just going to take a look at what's going on here. Okay, So what are we doing with this? I think first things first, we're going to, we wanted to also look at this. And much like we're saying, we see large cap growth go from, one of the the worst stock to one of actually the best today. So we actually are seeing exactly what we're talking about, a reversal of that trend. But the market is generally not doing that well, so we're going to adjust accordingly. Any questions on how we're looking at that before I move forward? Well, you can tell me, Stephen. I don't want to give people a weird screen.
Yeah, I'll let you know. Not seeing anything right at the moment, but I'll keep you updated.
Okay, so we are going to I'm going to be corny.
It is April's Fools.
Yeah,
Maybe the market is in the April
we're
Fool's
getting in on it. You think that do you think that was too mean of a of an update, Stephen?
No, I think it's a good lighthearted
It's a
moment.
good balance.
It's all in the same section, so it's not like we're gonna scare people too much. They just gotta keep reading another sentence, It's in all caps too.
It's only one. Okay. You're my voice of reason sometimes, Stephen. All right. And then we're gonna do our special little okay. Okay. See, another complaint I have about these Google Sheets is it just doesn't. Maybe if I do it like this again. Gotta let people know that. You know, it's nice. I've been blocking out my my whole morning from until 2 p.m., like 9 a.m. to 2 p.m. So I don't have any other meetings. It's nice to be relaxed in this.
Yeah, it's very different from the Wednesday one, right? With the time crunch.
Yeah. But, you know, better for like, definitely better for, um,
The viewers.
no, for my schedule, but like better for the view. I mean, I don't know. Maybe the viewers want a bigger rush. Maybe you can comment if those that watch us a lot, if they like the Wednesday update or where I'm much more rushed, or the Monday update where I could take my time a little more, write more, a more detailed letter. I just like to not be in a big rush. But we'll see. We're at the phase, like I feel like by the time we get to this part of the letter, like nobody really talks anymore.
16 away from 1500. Let's see if we can hit that before the stream's over. I think we will.
Well, what was our best? I think it was like over 2,000. I think we got to like 2,700 once.
I think it was definitely over 2000. I remember crossing
We've
that.
definitely cleared 2,000 before. All right, here we go. All right, so we got this, and then that's not where we want to be. All right. What is the other energy? Let's go in. Let's see. What's the other one that we're always in? Which one is that? Is it? I think NEE is the other energy one we're always in. Let's see. Yeah. All right. Energy. We're gonna take a look. We might get in to NEE right now, based on what we're seeing. Nope, we're seeing declining. We'll look for another energy stock, but we don't like that. We're gonna run a special. We're gonna run a special 30% off on our trading letter because we're being mean.
April Fools, full price.
That would be not nice. We wouldn't do that. Here. We already had this one locked and loaded. We'll make it till the end of the week. All right, any takeaways there? All right, now we're going to take a look at the technicals, and Stephen, because we want to get in the habit of doing this. If you want to get ahead of the curve, we're just going to go in order: Broadcom, BlackRock, CEG, Google, FANG. So right now, if you want to tell me on Broadcom what you're thinking, what you're seeing in the time series signals, as I look at the technicals.
Okay, let's look at Broadcom. Okay, so net option sentiment is at 89. It's rebounding off of 87 from the morning. It is hitting lower highs.
We're going to the next one. Technicals looks strong enough that we don't really even care that much about Broadcom, but lower highs, that's good info. Ooh, BlackRock.
BlackRock.
Great, yeah. Well, not great on the 30-minute. How about the 4-hour? Yeah, some inconsistencies. We got to keep our eye on it, but what's happening? Actually, we really care about what's going on with net option sentiment here.
Yeah, it's at 80. It dropped from 82 before. It kind of keeps hitting like 80, 82. It's pinned at that number and kind of consolidating.
Right. Not worth selling. CEG next, which should be, not looking good on the 4-hour. How about the 30-minute? Looking good on the 30-minute. You don't even need to check. I'll look at the 15, but I would say you don't even really need to check CEG because we're looking good on that. Talk to me about Google net option sentiment.
Google net options at 86. Is at 87 at morning. It's kind of recovering, hitting higher lows, hitting a new high. Looks pretty good.
Yeah, Google's looking good. That was a nice choice this week. All right, let's see this. FANG looking great. All right, now let's do a short update. Look at how organized we are today, Stephen.
Yeah, we're a well-oiled machine now.
I know. This is the best. I don't know. I guess we can share. Prospero we got a new capital injection, and we're going to be in really for the first time. I would say I have a nice budget for Prospero over the next 6 months, which is one of the reasons I'm so relaxed. Normally this morning starts out where I'm just like, I gotta perform well. I mean, I still anyone that has seen me for a while know I hold myself to a pretty high standard, so it's not like I'm relaxing, but it's nice to have the noose loosened a little bit. All right, rack space is looking good. I didn't give you a heads up. Tell me how GETY is looking in net option sentiment.
Very bad. It's at 6. It opened up at 16. It's hitting its lowest low, downtrending.
Yeah, that's looking good. How about GL?
GL is looking, it's at 39. It opened up at 48. So 48 was a new high in the trend though, but it's kind of declining off of that.
Oh, damn. LPL. Yeah, we really care about LPL net option sentiment. How's that looking?
LPL is at 29. It opened up at 30. It looks pretty good in a downtrend. Lower lows, lower highs.
Yeah. What's current QQQ net option sentiment?
43 for the QQQ.
Why are you like this? I guess we're gonna be very hacky. Actually, I might bring this up here. All right, what do you think, Steven? A nice call to action?
Oh yeah, it's always got to be call to action. Speaking of call to actions, has everybody seen the link to Spotify in our description? If you haven't yet, click it and follow us on there.
All right, we're probably only going to do one April Fool's joke. All right, we got everything there. It's a good letter. Now we got one more letter. That was just the first one. Okay. Now I don't know how well updated this is. Let's see. How's that Allstate investment doing? Not great. Well, if we miss some things, we miss some things. All right. UNH, you're not looking good. Shockwave, even worse. What's going on? What's going on with Square? Anyone know what's going on with Square? All right. Let's go one at a time. Okay, first, we're pulling up this letter. I don't think we need to do. We just posted the other thing. We're just cutting to the chase on this letter. Are we winning or losing that UNH trade, Steven?
UNH is a loss currently.
All right, we're going to keep our eye on that, but we're not quite getting out of it. It's got a nice trend. How about Suave? Suave.
Which one?
Suave, SWAV.
Suave is a win.
We're going to grab that win. How is the net option sentiment trend on Suave?
Suave is at 8 and it opened at 39.
It's not great. What's going on with Square?
Yeah, it dropped a lot. Square could be trading with Bitcoin maybe.
It's recovering a bit in the 10-minute. But we're gonna do our classic bold of death. Our classic ODFL went down that much. What the fuck happened? Oh, we're not adjusting for splits there. Well, that'll definitely help. All right, we're gonna have to correct that later. But that's good to know. Our portfolio, the return on the model portfolio will be going up. We got to look for other instances of that because we're not updating for splits. Oh, how's ACN doing? Always are. Oh, Novo Nordisk is starting to. How are our Novo Nordisk positions? Wins or losses?
Novo Nordisk. I see a loss, one loss. Another win. One loss, one win.
One's a win, one's a loss.
Yep.
All right, we're gonna grab that. We're gonna grab that win. What's next? Ooh, MCK. Where are we on those MCK positions? And then if you can give me a net option sentiment trend after, well, I might look at the net option sentiment trend. Just tell me where we are on the positions.
MCK 2 wins.
We're gonna grab these healthcare wins because we are seeing the start. But we'll open up new ones again if we see them recover. As we always do. Okay. Ooh, how about Eli Lilly?
Eli Lilly. We have a loss, a win.
We should only have 2
That's it. Yep. Loss and a win.
All right. I never thought. I mean, we had a lot. We were loading up on a lot of healthcare, but that's good. We were doing well. How about CDNS?
CDNS, loss and win.
All right. One of them too. All right. Booking.com. BKNG. How are we doing on those BKNG positions? Loss or wins?
Loss, 2 loss.
2 losses?
Yeah.
All right, we got a lot of wins here. We'll take 1 loss. I think it's finally. I don't know what I was thinking holding on to that ACN position. I knew it was garbage. Let's see if there's any hope in the technicals, but I'm probably just buying more fool's gold. I should have never. Closer to shorting Accenture, yeah. No, we're not going to short Accenture. But we're ending the Accenture experiment. It was never that good in our signals. Okay, one thing that we definitely want to do is $60 longs. How many shorts? 64, okay. It's been pretty good. Now let's do the short. What's going on? Is VIR a win or a loss?
Say win.
How about the net option sentiment trend on that?
It's at 65, bouncing off of 23 from this morning. It's very volatile. Goes up and down between like 70 and 20 throughout the whole trend.
Are both of the U.S. still position wins?
Win and yeah, both wins.
Don't like where that's going. I'm going to look at VIR myself and tell you if I see anything there because I'm a little nervous about the volatility, low profitability and growth. Yeah, we see it kind of bouncing. Oh, we've been learning sometimes our thing gets a little behind. And so we've actually been why is it not having what I ran this morning? You guys get to see the extent of my coding skills here. I want to make sure we get a live update. Sometimes, for those that don't know what the time series, we do get questions on that. I'm like, sometimes it gets a little behind. If like our system's running, like we actually prioritize updates of the signals, and we do get that question. Like sometimes with people saying, with people asking, like what's going on, the 10-point graphs. So what we shared like right here, these are always going to be the current numbers, and we actually prioritize. Oh no, that's not that. Here, if we go in the letter last week. Anyway, the 10 points on the top of the app. I don't think anyone really needs me to explain that too much. Those are what we prioritize updating. So sometimes other things get a little behind because of that, like the time series. So what I'm doing is I'm like on a different thread, manually updating the time series, which I'm trying to do more to make sure that it's done in a timely fashion, because the earliest it could possibly update is pretty much now, because we use generally around 12:40 as midday. And you can see right there in the time series what we end up using. But I wanted to get another reading before we finish this, is why I another time series reading in there to make sure we do it. All right, so these are going in a good direction. VIR, we're going to do the, I'm not sure what I want to do about VIR yet. So we're gonna give it the old bold and watch it today. Oh, we're in the wrong thing. No wonder. All right, anything else? We looked at GL already. We were fine with that. LPL. Oh, we skipped past. I knew there was one. We skipped past out. You want to tell me what the net option sentiment trend on out is?
Sure, it's at 55 right now, opened at 56. it's hitting higher lows and lower highs. So it's kind of just condensing right to where it's at now, 50, 55.
How about FYBR?
It's at 48, bouncing off of 36 this morning, downtrending, lower highs, lower lows.
Lower highs, lower lows, you said. That's
Yep.
good. How about FRHC?
It's at 46. It was at 6 this morning. It's I forget the one we just looked at before that was very volatile. It kind of looks like that. It's just going up and down between like very low and the mid 40s.
Almost to the end here. Gold is looking fine. AMED, let's check out. Oh. Down here, I was looking in the wrong spot. What's going on with you, AMED? You're pretty all over the place. Not AFMD. All right, we're almost to the end here. Oh, Jesus, there's something going on. Well, affirmed overweight by Wells Fargo. You know what? We're going to exit AFMD right now. And for those that can see, we're really seeing it like climb, basically. You know, I think that we don't want to like. Sometimes it's just like fine whenever the letter goes out, but this one's like moving up so fast that we're exiting. We're exiting right this second. And this week we're going to be very conscientious about when we send this out because, well, I think Brent messaged me, I saw, who normally helps me with this, but I actually have to do all this labor manually this week. Okay. All right, we're done with our updates. Wow, making progress. Oh no, wait, we're not doing that. All right. We're skewing even more short, but let's see. Let's see if there's, we definitely want to look at energy longs. Anything else looking good? Energy longs, we want to target consumer discretionary shorts. All right, we're going to look at comms. We're going to look at comms, energy, and we're going to look at comms, energy, and communications longs, and then consumer discretionary, healthcare, technology, utility shorts. All right, so we'll go one more time. I'm just going to bold this so I remember. I'm going to bold the shorts. We're not touching that yet. Okay, so these are the shorts we're going to look at, and then longs are going to be materials, energy, and communications. Great. All right, so what did we say? We said we were going to look at, we're looking at longs and comms. And we said comms, energy, and materials. All right. DoorDash is considered communications? All right, getting rid of these because we're all loaded up on it. What's going on with, well, we're gonna paste this in. We're not gonna. Where are we gonna paste it in? I think this might be our best update. What do you think, Steven?
I agree, and it's just in time for Q2. So, new playbook being implemented.
Yeah. And, you know, if there's one thing that I always teach, it's that it's making sure that it's making sure that you are adjusting. And that's what we are obviously doing here. And it's preparation, right? It's all the work that we did on the newsletter and everything that's informing a very good strategy for this. So we want to high. Well, let's see how far down 18 gets us. Because I do like all these energy names. I might delete some other ones. That's 18 down. Okay, that's good. We have enough. And we have some good new names to throw at people, which I like. Do we have any open DoorDash positions right now or NFLX?
Yes, we have one open DoorDash. No NFLX.
How did that one survive? Well, how is Val here at this low of a gain? We can't abide that. I think we have a PSX. I mean, we'll take a look. That's crazy. Well, I think we just won't do anything about it. How's the net option sentiment trend on Spotify?
It's at 77. It's decently good, slightly uptrending, higher highs, like very slightly though.
How many FANG positions do we have? I think just one.
FANG, I see 0.
What? Really? Are you looking in long?
Yes.
Oh, that's an oversight. Jeez. It's a big snafu. Whatever. All right, AMR. I know you said you. What did you say about Netflix? You said you didn't. Well, talk to me about Netflix's net option sentiment trend.
It's at 67. It's starting to downtrend pretty good recently since March 27th.
Yeah, I don't like it. No, and actually we do want to go. I'm going to move this over here so I can look at both in a little more detail. MLM is another material, so I might want another. How's the net option sentiment trend on MLM?
Very stable. It's at 72. It was at 73 this morning. It's very neutral.
It's just not good. It's just not a good enough setup. WRFD. Oh, we have some other materials ones further down. Weatherford International. Ooh, that looks good. What's going on with all these? Oil field. All right, whatever. Oh, look, from our short. Some of these companies as communications is very interesting. How's the net option sentiment trend on Take Two?
It's at 67. It's also pretty neutral, just between 60 and 70 throughout most of the trend, bouncing between that.
I'm unconvinced. But Lin looks good. I don't know what Lin is, but I think we have an open XOM, right?
We do.
It's probably enough. What is going on with these uranium stocks? UEC, anyone in the audience know what's going on with the uranium stocks? UEC and CCJ. No, not Matador. PXD. How is the net option sentiment trend on SCCO?
It's at 72. It's hitting highs of low 70s throughout the trend and higher lows.
Look at us. We're really changing the makeup of this portfolio. What did you tell me the net option sentiment trend on FANG? I actually don't know if I want to 2x it or not.
FANG is at 59. It's downtrending ever so slightly.
Okay, so I think on shorts we're doing industrials. I remember industrials, technology. Consumer cyclical. All right, I got I got our little picks here. Do we have an SPCE open?
No.
We closed. A little too early, it sounds like. All right. We definitely closed too early, but whatever. Ugh. That is a really good. Well, do we have any whoofs open? Ooh, S-Fix is an old favorite of ours.
No woofs.
Jesus, I wish we had held. Oh, God, that one was a mistake. That's been low in our signals for so long, and it's just I don't know why. I don't know why I didn't hold that. It's dumb. Now with it down so much, I'm worried about it. Well, we'll keep our eye on it. I think we have. Tell me if we have any open PCTs or Wish. Actually, can you see? I'm just going to post this in a Slack to you.
We have one of each of those.
Of each of those, okay. That's probably fine. How about IRBT? How about these next three? MAXN, missed.
IRBT, no. MAXN, no. What was the last one?
Missed.
No.
We got out of those. That's a new one. Miso. Wow. That's interesting to be so high. All right, we're gonna keep our eye on what is going on. I'm looking at this myself. What is going on with Miso? Because it's up a lot. Yeah, net option sentiment just took a plunge. Just a fresh plunge. 24, 37. We're going to take a flyer on this. It looks like it might be losing its... Do we have an ERVI open? I don't think we do. These are like, it's like a who's who.
Yeah, no ERVI.
After this call, I'm going to come back. That's EVRI. I mean, there we go. I don't know why that wasn't working. What is this? Casinos, gaming. How's the net option sentiment trend on this looking?
For which one? ERVI?
Mm-hmm.
I don't actually see it in here.
ERVI?
Yeah.
Do we have any open AALs or CPRIs?
No to both.
I'm looking at the net option sentiment through CPRI. I think we might target this again. 14 at 9. Yeah, we're buying this right now in the investing portfolio. As a short. We might have more shorts, but this just looks like a great. Wait, did I look at this right? On the 30. Yeah. Yeah, this just looks like a great opportunity. Yeah. Another great opportunity. Okay. Did you tell me we had an RXT open or not and an AAL? I think we have an RXT.
AAL, we did not. RXT, we do.
Can you talk to me about the net option sentiment trend on AAL?
It's at 26. It's towards the lows of the trend. It's hit that level a few times. It's been as high as 33, so it's pretty. It's not very volatile.
I like this RCM short. I might add it too. I'm looking at the trend in net option sentiment. Very good trend. It is growing, but that's good. I think we're getting in this RCM short too. Let me just look at what the industry is. I think it's tech. Healthcare. Interesting. Yeah. Okay. Sorry, everyone. Just entering the RCM short too. Sorry, what did you say for AAL net option sentiment?
It wasn't very volatile. It's just kind of going between like 33 and 24-ish throughout it. It's at 26 right now.
We'll take a flyer here. ACGO looks like an interesting short. I mean, I think we took the ones that we wanted to on our newsletter picks, but we're going to look into all of these, both long and short, as the day goes on. We just kind of rushed into those shorts because I am noticing SPY and QQQ kind of go in a bad direction. All right. A lot going on here today, everyone. I decided not to double up on FANG. I'm going to try to send this out on 125 to make my life easier. All right. All right. Got to do it at 125. We don't want to miss it. All right, now we're going to shoot for 130. That'll actually be an easier time to adjust. All right, market update. Take a slower look at this now. Geez, we've been doing this for 2.5 hours. I didn't even realize.
It's been a movie, as the kids say.
Let's get a bit of a live look at these. Oh, God. No, we're just going in here. All right. Do this. Okay. This monster of an update is going to be sent right at 2:30. Right at 1:30 to make sure we time it right. But any questions, anyone? Gonna stop sharing, about to send this before we go.
Ramel was asking how you can get access to some of the documents you were going through.
Who is?
Romel
Romel?
Camara.
Are you if you're a paid trading letter subscriber, I'll share the documents with anyone that's a paid trading letter subscriber. Much like the model portfolio, there's things that so yeah, if you are, email me, George@Prospero.ai, and I'll share any of that with you. We also put in the paid investing letter, I'll put it here. This is a discount code to, I remember to hit send on this, right? Yeah. This is also a 30% discount code to the trading letter that you guys can use too if you sign up or are already signed up. You can email me at George@Prospero.ai and just let me know and I'll give you access. All right. Any other questions before we end this marathon?
I don't see any. Romel says thank you though, so maybe we'll be getting an email from him.
Awesome. Thanks everyone.
Yep. Thank you, George. See everybody back here Wednesday, 3 p.m.